Alright, today is Wednesday, September 9th, and this is a post-market review for today's activities in the stock market. Here is the agenda of the day, and of course today we will discuss some of the gambling activities in the options market in depth, specifically a phenomenon called reverse conversion. And we will also discuss some charts here, more charts than usual. We will talk about the triple Qs, the SPY, the VIX, the TLT, and the dollar index. So here we go. The Dow Industrial Average closing in the green, 439.58 points, or a gain of 1.60%. The Nasdaq leading the recovery today, an increase 293.87 points, or a gain of 2.71%. S&P 500 closing in the green by 67.12 points, or a gain of about 2%. What about the sector's performance? Everything is in the green today, and the gold medal goes to technology, the silver to materials, imagine that, and the bronze goes to consumer cyclicals. Moving on to the futures market, look at crude. Crude bouncing back along with the market, not recovering everything it lost yesterday, just about half. And of course we see softs and grains very muted with exception of lean hogs and soybean. From my observation watching the futures market, I have noticed that lean hogs and soybean products have been recovering as of late. This could be an explanation to what's going on behind the scene. On surface, the Trump administration is talking tough against China, yet the Chinese are increasing their purchases of soybeans and hogs for American farmers, which means that there is a facade of an exterior policy of let's talk tough against China. Meanwhile, behind the scenes, the Chinese are helping the president by helping our farmers, assuming of course the farmers will support him. And that goes to the nature of politics in China, or China's preference to deal with the devil they know. At least this is the way I see it from watching the futures market. And of course the decliners of the day in the futures market today, OJ, coffee, lumbar continues to go down, and of course you saw canola giving a little bit of the gains it booked yesterday. And moving on to the big casino, the options market. Let's see what's going on. Yesterday, you saw a little bit of fear among gamblers. The market might go down. Actually, some of the Weisenhammers decided to switch from buying calls on autopilot to buying puts yesterday, and they got smoked like a piece of salmon today. This is what happens with gambling. You think that you know what's gonna happen tomorrow, but you don't. And you start trading day by day, making big bets using options. Trust me, the market will flush you out. You are one of the weak hands. But anyhow, we saw recovery today in call buying, the reverting back to what worked for them. This is of course the trap of market Darwinism. They will think that the smoke is clear. Let's go back to buying calls. Look at Tesla up almost 10% today, Apple up 6% today, and what do you know? They accumulate lots of calls expiring for the same week, and the market reverses and eat them alive. So here is what happened. Apple leading the day per usual. 2.2 million options traded today, 71.4% for calls. Coming in the second place, Tesla with almost 1 million options traded today, about 53.4% of those are calls. Tesla remains the most dangerous stock in the market today. I will get that in a second, but let's talk about number 3, Slack. Slack got a smack in the mouth yesterday, big decline today, yet the gamblers are betting on a bounce. 530,000 options traded in Slack today, about 63% of those were calls. Now I want to talk about Tesla stock for a little bit, re-options, and I released this tweet saying that Tesla is the most dangerous stock in the market, and if you buy it today, you will be or could be collateral damage to all the gambling happening in the market, specifically the phenomenon of reverse conversion. A few days ago, we talked about gamma squeeze, the phenomena of gamma squeeze, when the gamblers stampede the options market, buying out of the money calls, expiring for the same week, pushing the stock higher, and then options riders have to scramble and get squeezed They buy the stock to cover their asses, causing these impulsive moves to the upside. Here is another phenomenon. Maybe you've bought a put option on Tesla last week. Yesterday, the position was up big, as the Tesla, of course, was down over 20%. Today, Tesla rebounded, and you would naturally think that your put options on Tesla now have decreased in value. The delta went down, but in certain cases, depending on your expiration date, that actually didn't happen. What happened is those put options actually increased in value. How do you explain that? Here comes reverse conversion. Reverse conversion happened when option prices are so distorted, the premiums are so high. In the case of Tesla, they're insane. They're out of whack. You're wasting your money if you're buying Tesla options. You might as well flush your money down the drain. Certain traders take opportunity of that. They short the underlying stock, in this case Tesla, and then they buy a put and a call for the same strike price. And in this case, they don't care whether the stock goes up or down, because using this strategy, they end up scoring anyways. But sooner or later, the stock has to go down due to the activity in the stock market. When you buy a call, there are consequences on the other side. When you buy a put, there are consequences on the other side for the people who wrote you these options. When you combine all these gambling activities in the stock market, you have extremely dangerous conditions where stocks can go down 20% in a day, up again 10% the next day, down again 15% the day after. Is this really a stock you want to be in? This is a storm that would eat you alive. You will never be able to time it right. Get the hell out of Tesla stock. I know that the cult is waiting for Battery Day's revelations and they will pile in to buy the stock. That could lift it a little bit, but remember that the gambling in the options market is still there, so there is extreme volatility ahead for Tesla. And by the way, this gambling pandemic in the options market has to stop. It has distorted the market, it has ruined the market for the rest of us. If you're a disciplined investor and trader, you can't do anything in this market. The gambling in the options market is dictating these moves, creating impulsive moves. Just look at the correction we had, 10% in a matter of days. And of course, we rallied impulsively during the last couple of weeks in August. You might assume that volatility is your best friend as a trader. That is true if you are actually a psychic, not a trader, and you can time your moves specifically. If you're gonna play day by day and you bought puts yesterday, you got smoked today. Maybe you are seduced by the market's action today, you're gonna buy calls, tomorrow you get smoked. Be careful here, stay disciplined. Because the Robin Hoodiots and the gamblers have discovered the options market. And in their mind, it is the poor's man way to become rich quick. Of course, they've been accustomed to buying calls, and that's been working for them. But now the game has changed, and there will be lots of casualties. The gambling in the options market, the gambling mania in the options market must come to an end so we can have a healthy market again. And we know, of course, that the end will come by destroying the accounts of all of these gamblers. They spend 4-5 months gambling, building their portfolio quote-unquote gains. They will lose it in days. And now let's move to the headlines that shape the day. Speaking of gambling, of course, the king of gambling, Masayoshi Son, who just spent billions of dollars buying calls, distorting the market, manipulating the market, and who knows what he's doing right now. Is he getting smoked? Will he panic? Will he sell? Did he already sell? Who knows? We don't have this information. All we know that SoftBank was manipulating the market, and now this is starting to fire back against SoftBank. Shares of SoftBank overnight were down 7%. In this week alone, down 13%. Expect Masayoshi Son to panic and to do an extreme irrational move soon that will hurt the stock market significantly. And of course, the whole saga is becoming extremely worrisome. Now we know that the chief compliance officer is leaving SoftBank because this has turned from an investment firm, from a venture capital firm and a conglomerate into a hedge fund, gambling as if it was a Robin Hoodiot playing with his phone, thinking that the options market is a video game. And again, the options market, moving on to the next headline. Here are some tech investors who happen to buy puts on the triple Qs right before the market crashed. The manipulations, the pump and dumps, they're all coordinated behind the scenes, and don't expect the SEC to figure out anything. they're dormant, they're asleep, they're useless. And when there is no watchdog in the market, you're gonna see these activities. They're coordinating behind the scenes, pumping, dumping, and there will be lots of victims. In this case, of course, 137 billion in the open interest of triple Q puts last week alone. And here is the chart, and you can see the surge of put buying on the Qs right before the market crashed. And moving on to more manipulation, the interest or the short interest in the TLT that tracks the long-term bond prices have increased significantly to the highest level since 2018. So now they're betting against bonds as well, and you saw that bond yields rallied as stocks went down, which is not usual for a typical correction and a typical market sell-off. So something funny is going on here. There's a lot of manipulation behind the scene, and all of this gambling will come to an end by exploding back on the faces of all the gamblers and all market participants as well. And speaking of the mania, you know, if you've been watching this channel, I've been describing it as a mania, as a stock market mania, and I've been comparing what's going on in the market this year to the 1999 bubble. I've been doing that all the way back since June. And now the media and big players in the market are catching up to it. You've been hearing the term dot-com bubble and 1999, 2000 a lot on CNBC and other financial networks. And of course, today we had an interview with Drunken Miller, and he described it as a mania, and he is right. It is an outrageous mania, and it's going to end very badly.
I think the merging of the Fed and the Treasury, which is effectively what's happening during COVID, sets a precedent that, well, we've never seen since the Fed got their independence. And it's obviously creating a massive raging mania in financial assets. And as you just pointed out, Joe, it has not spilled over to Main Street. I would just say that I hear a lot of people on the air applauding Jay Powell, saying he saved the world. And I do think he did a great job in March. I think the follow-up's been excessive. And I just want all you guys cheering him on to remember the maestro in 2005 and how that worked out. Look, everybody loves a party. Jeff loves a party. Kwame loves a party. I love a party. I assume you guys love a party. But inevitably, after a big party, there's a hangover. And right now, we're in an absolute raging mania.
And moving on, of course, yesterday we heard the news from AstraZeneca putting their vaccine trial on hold due to one of the patients getting sick. That, of course, had a market impact today. You saw the shares of AstraZeneca down, but you also saw the reopening stocks, specifically the very sensitive ones like airlines, cruises, hotels, casino, getting whacked today. Now, I'm not putting a lot of emphasis on the AstraZeneca trial or the vaccine because there are so many trials going on. And of course, you saw an explanation happening today after market. AstraZeneca shares recovered, and I'm assuming tomorrow the reopening stocks will recover as well. Airlines, cruises, casinos, etc. Here was JP Morgan saying that some employees and clients misused the stimulus money, aka the PPP loans, saying that some employees have fallen short too. Again, don't expect the Justice Department or any watchdog to investigate that and hold the people who misused public finances responsible. They're all gonna get away with it because it was a decision from the most corrupt Treasury Secretary we've ever had, perhaps, Mnuchin, opening the vaults for looters to come in and rob taxpayers' money, stealing from the poor, giving to the rich. And now moving on to the heat map analysis, and as you can see, it is a sea of green across the board, with very few exceptions. We talked about these exceptions in the discussion of the AstraZeneca announcement. You see shares of AstraZeneca were down, the airline sector was down, travel sector, cruises were down, lodging, hotels, casinos were down, but not all the comeback stocks, as I call them, my picks, were down. You saw Cisco rallying, Mondelez, Emerson, lots of the industrial names and the consumer cyclical names were not affected by the vaccine news. Only the very sensitive sectors were affected here. And that can be, of course, illustrated by visiting the rotation trade, the vaccine rotation trade. As you can see, it was a rebound day for the momentum stocks. They got whacked severely the last few days, and now they're rebounding significantly, which is very dangerous. These moves, impulsive moves up and down, will create a lot of volatility, and there is no stability in the market whatsoever here. Yet you can see the stability on the other side of the aisle, on your right-hand side in the comeback stocks. Airline, cruises were down. Casinos, not so much. You see MGM wasn't down by much. Marriott, not down by much at all. And a lot of the names managed to close in the green, as you can see. I'm not ready yet to buy airlines and cruises, and I was very conservative in picking Southwest and Royal Caribbean to this list. I have yet to buy an airliner or a cruise operator, due of course to the risk of vaccine headlines. But I am nibbling and opening positions in the rest of the names you see on your right hand side, and I see the dips as an opportunity to buy, and I've been buying and adding to my positions in them because I'm looking for stability, not volatility, in my stock investment strategy. I leave the volatility for my options investment strategy. And now moving on to the charts analysis, starting with the chart of the QQQ, the Nasdaq. Right away, from a daily perspective, we have to compare the look that we have right now in this specific correction to the correction we had back in February earlier this year, the COVID correction. As you can see, we flushed down severely, but we had a bounce. That bounce was a dead cat bounce, and we saw the resumption of the selling thereafter. Are we seeing a similar situation here? I would argue yes, and I will show you how to confirm it and what to look for as indicators that this is a dead cat bounce. Now, make no mistake that a dead cat bounce can go higher than you think, specifically given the gambling activities in the options market. So don't try to be a Weisenhammer and short based on day-to-day activities. Look at the big picture. And of course, some analysts, you might have heard, technical analysts said that we bounced from the 50 moving average, 50 days moving average that is. I don't use the 50 days moving average. I identified the support precisely without the need to look at the 50 moving average. And when we switch to the 15 minutes chart of the QQQs, I released this tweet identifying the resistance points for now. And you see that the shares struggled to break through the first resistance in or around 277.50. However, we broke ahead of that, and now we're eyeing the next resistance and the next natural place for the Qs to reach, closing the gap from a 15 minutes perspective. This is of course the gap we've created in Friday. This is the natural expectations of the Qs. We need to see tomorrow the Qs rallying, going all the way to the gap, closing it, and then rallying ahead of it. That would be the bullish scenario. However, I've seen a lot of weakness right after we passed and broke through the first resistance. I was expecting clear skies where the Qs are just gonna rally and move like a magnet to the gap. That did not happen. I saw a weakness, and make no mistake, if the Qs reverse down before reaching the gap, that would be a very bad signal technical wise, and it could trigger a sell signal, aka a shorting opportunity. So keep your eyes right there. And now when we switch to a weekly chart of the QQQs, I warned you yesterday because some viewers messaged me and said, hey, the chart, the MACD from a weekly perspective crossed the blue line and started creating red impressions. And my response was, this is a weekly chart. It does not count until the end of the week. Be careful. And as you can see today, that red impression disappeared from the weekly MACD due to the reversal and the bounce we've seen today. It doesn't count until the end of the week. You have to stay disciplined. You don't have to trade every day. Sometimes you need to sit back, grab the popcorn, and watch the show. And moving on to the SPY, the S&P 500, from a daily perspective, right away my eyes and my training tells me watch out for a potential bear flag in the daily chart of the SPY. And of course, when we switch to a 15 minutes perspective, you can see the build-up of the bear flag a lot more clearly. And of course, we've gapped up today. However, the last few minutes of the day, the last few hours, we flushed down significantly. We managed to close in the green, but that flush down was worrisome to a lot of traders. For now, we're not going to read a lot into it, but it is negative. You expect, of course, in a healthy rebound, that traders will feel that the water is warm, will join the rally again, and you see lots of short covering at the end. We did not see that. We saw the opposite, a sell-off at the end, a mini sell-off, granted, but it is a reason for concern and it raises the alarm. For now, we're not going to make a big deal out of it, but if the market reverses tomorrow, trading in the red, you know that that was significant. And of course, the target here for the SPY, if this is a real bounce, is to go all the way and close its own gap from Friday. A reversal before the gap, likewise in the triple Qs, would be very negative and a signal to sell and to short. And what's going on with the VIX? A VIX from the daily perspective here, the question begs itself. Is this going to be another tease like we've seen in June, where the VIX pops up and then it cools off and continues to grind slowly and painfully to the downside? From a technical perspective alone, no. Because when we switch to the weekly chart, you can see that the last time the VIX popped from a weekly perspective, the MACD did not cross the blue line and did not create green impressions. This time is different. And in the VIX chart, that crossing and the the green impression happened last week. So it's already in the books, it's already counted. And the natural way from a technical perspective is you're going to build on that. So perhaps the VIX is taking a break today, but will continue to surge higher in the days and weeks to come. Now, one more thing I want to answer regarding the VIX. Certain traders, of course, asking me, why is the VIX down or why is it muted? Meanwhile, technology stocks are getting whacked hard. There is a reason for that. And of course, you know that the VIX tracks the action, the put options activities in the SPY, the S&P 500. The S&P 500 has more sectors than just technology. Technology is a big sector of the S&P 500, but it is not the only one. So when you see technology getting hammered, yet financials rallying, industrials rallying, utilities rallying, the VIX naturally could pop and trade in the green, but it will not trade as high as you expect, so long as we see the mixed picture between different S&P sectors. On the other hand, the short triple Q and any inverse ETF that tracks the Nasdaq specifically will appreciate significantly when technology stocks are hammered because they track tech stocks specifically. That is the difference, of course, between the VIX and a Nasdaq inverse index like the short triple Q. And one more warning. I know that a lot of you like to gamble and like to trade the UVXY, which is the ultra velocity index tracking the VIX. Not only that, but buying and trading options on the ultra velocity index, the UVXY. Understand that you are playing with fire. You are playing with a lot of volatility. UVXY can trade really, really high if the VIX rallies. But if the VIX stay muted, it doesn't even have to go to the red and trade in the red significantly. You will see the UVXY trading in the red significantly because it is an ultra velocity index. So keep that in mind. Moving on to the dollar index chart. Here's a tweet I released in the morning, reminding you, of course, that yesterday we talked about the dollar index. If we see a reversal overnight, intraday reversal in the dollar index where it closes in the red, that would be a signal for a bounce in the stock market, and we saw that happen today. The dollar index reversed. Say if tomorrow the dollar index does the reversal of the reversal thing and it starts to rally, that would be a signal for a reversal in the stock market. Of course, the dollar index and the stock market are not correlated, but during significant sell-offs, you have to watch the action in the dollar index because it tracks the panic to raising cash. We haven't seen that yet in a significant and meaningful level yet, which tells you that we are not in a panic right now. And you can see that, of course, if we switch to the TLT, which tracks the prices of bonds specifically the long-term bonds. From a daily perspective, there is no panic. In a typical sell-off, you see the rush to buying bonds, driving prices higher and yields lower. That did not happen yet, so we are not in a panic. You have to watch for the action in the dollar index, TLT, and gold to confirm whether we have reached a panic level in the correction or not. For now, the greed, the arrogance is still in the market. This is what the action and technicals tell me. And of course, let's conclude the video. The gambling mania continues and the epidemic of gambling in the stock market via options goes on. The show goes on, and that will intensify again if we see another green day tomorrow. A lot of traders will assume that the smoke is clear and let's go ahead and continue to gamble buying call options by the bulk. Likewise, a lot of usually disciplined traders are seduced by the huge volatility and will try to time the market, buying puts here, buying calls there. You will get burned. Watch the macro picture, the big picture. Do not be seduced by the micro picture and the day-to-day and the intraday activities. You will get burned. I gave you what to watch for, technical wise, to confirm whether the bounce will continue and evolve into a rally and a continuation of the trend. I seriously doubt that. And I also gave you what to look for to confirm that this is a dead cat bounce and the reversal thereafter. This is at least my take, and I released a tweet today saying that the action today is another opportunity to book profits before the red storm, the selling storm, hits again. And remember, the market has a very funny way in conducting market Darwinism. It will give you one signal and one picture, one facade. And if you're seduced by it and you make impulsive trading decisions, what do you know? The market will peel the picture and says, ta-da, I fooled you. The reality is different. So stay disciplined and stay smart ahead of the market. Don't be fooled by what the market is doing in the short term. And that is the message of the day. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.